You're listening to the Generational Wealth Through Commercial Real Estate podcast. Your host, Will Smith, is a former NFL player that found his passion in commercial real estate. Every week, you will learn from industry experts everything you need to know to get started investing in commercial real estate to build generational wealth.
Thank you for tuning in to the Generational Wealth Through Commercial Real Estate show. I got a very special guest lined up for you today. But before we get into that, if you're watching this show for the first time, do me a favor and go ahead and hit that subscribe button. You know, I'm trying to grow the show audience right now, and hitting subscribe lets me see who's listening, how many people are listening. If you've been watching this, listening, and you haven't left us a review, go ahead and do that now. These reviews are how I keep bringing on rock star guests like I have today. Today's guest is John Fortes. John, along with his wife, Jenn, and their two beautiful children, boy and girl, a boxer, and two cats, reside in South Boston, South Shore of Massachusetts. John is also known as the passive investor consultant, founded the Fortes company, which partners with working professionals seeking to invest in diversified commercial multifamily fund because they don't have the desire or time to own real estate and fully operated. The fund has invested in over $70 million worth of multifamily investment. So John he's crushing the game right now. And man, we're excited to have you on the show, man. Thanks for coming on today.
Hey, it's a pleasure coming on the show, man. I'm honored to be on your show, man. It's great to know you and see what you're doing out there. And Real quick, before we get started, I know you already mentioned it. If you haven't already, like and subscribe to the show, leave a review. It means the world to podcasters because it helps them get guests on and it helps them send the message and spread the message to other people that want to hear it. Appreciate
that. So, John, man, give us your background, your story on, how you got to where you're at now. Because a lot of people see, the person sitting at the top of the mountain, but they don't understand the journey that it took to get there. So if you would, man, tell us about that.
Appreciate you saying something like that because I don't view myself at the top of the mountain, and it's just kind of like throws me back when you said that. But my background is I started with one single family home investment. Before that, and that was about two years ago, and before that, 5 years of analysis by paralysis.
Yep.
Paralysis by analysis, analysis by paralysis. I hope I said that right. Either way I did, right?
Right.
But here's the thing, right? So it took me about 5 years. And during that 5 years, I was trying to study the stock market game. And I didn't really fully dive into real estate until like 2.5 years in. So the stock market game, I was reading all these books on how to invest in the stock market because I had a 401k. I want to see how can I double this, triple this, or whatever I could do.
Yeah.
And it was too complicated to learn. I'm not a broker. I'm not someone on Wall Street. I'm just, trying to do IT stuff at the time.
Right.
So I fast forward, we buy a house, we do this, we renovate, we get it appraised, we refinance, do more work, appraise again. And I just saw the value in basically doing work to my own home. The equity was growing.
Yep.
I said, okay, let me dive into some of this real estate stuff. So I started looking at essentially I wanted to buy I wanted to do the BRRRR strategy where it's basically you buy, repair, refinance, rent, refinance, repeat, right? So I wanted to do that strategy. I bought a turnkey house. That was my lack of inexperience. I wanted something kind of like more safe. I was like, all right, I don't got to do all the work. Let's see if I can get something. So It's cash flowing. It's fine. I bought it right. And that was the most important thing. It is cash flowing to this day. And the end of the day, while we were closing that, it seemed like a bunch of podcasts and books and stuff were coming out about multifamily. So I turned to my wife. I say, this is the last single family we do. We're going to scale. It makes more sense to buy more doors under one roof.
Right.
And she was on board. She said, you researched it, obviously, in the way I presented it to her. And we prayed about it. And then we started moving forward. Immediately after we closed, I purchased some educational platforms. I started learning about the concepts. I started devouring podcasts and books, and I started asking a ton of questions. That's where the learning came in.
Right.
So it was like listening to podcasts like yours, learning something, and someone in a community or a forum or a private community that I'm a part of asked a question. I said, well, I heard on this podcast, boom, 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 boom.
Right.
And they would, the reason why I would do that is it would either affirm that I knew the information and I was correct. And even if I was wrong, where I was wrong on a few occasions where things that I've read or heard, someone would come in and say, hey, John's wrong, but here's the right way to do it.
Yeah.
I put myself out there. I don't care.
Right.
I got the right information.
Right.
And I was usually answering comments on things that I was interested in, or it was like something that I was coming across at that time.
Yep.
So that was the biggest thing where it helped me learn. And now I had to go and implement that.
Yep.
So now I'm part of a few communities, and all of a sudden, next thing you know, opportunities started coming about. People was, hey, we got this JV partnership opportunity, and we invested into a 62 unit. 5 months from there, we did our first syndication. 8 months from there, we did about our next syndication.
Wow.
And it takes a long time to come across deals because we're trying to find the right deals to put people in.
Right.
And our first syndication, we held it for 18 months. And since then we have exited in the middle of COVID. Everything was lined up. All we had to do was sign the papers, and it was a 1.5 multiplier on the exit for our investors. So they were very happy to get a return on their capital, even though we were cash flowing at 9%.
Yep.
The decision behind that was, if we're already going to get 50% back of our capital, why hold it for the remaining, 4.5 years? 4 more years to get an additional 50% of our projected returns.
Right.
So, having conversations in a network to be able to bounce that off of, why would I sell at 50% and not, was very meaningful and very beneficial to have in my back pocket because of the network I've built up all by asking questions. Yeah.
No, that's very interesting, man. And that's a great story, because I feel like your story is very similar to most people that start investing. They start on the residential side because it's just what they know. They know single family homes. And then, as they start listening to, podcasts like, your podcast, my podcast, they get on stuff like Bigger Pockets, they start learning. They say, well, daggone, it makes a lot more sense to scale. And then it's just trying to figure out how syndication works, how to, put money together, put deals together. So that's definitely good to know that, it can be done, and you're living witness of that. So, tell me, man, before we got onto the show, we were talking about, raising funds and, syndications and funds of funds, things of that nature, man. I want to really dig into this and see, how does that work, and why would, someone consider doing a fund instead of syndicating, one-off deals?
That's a great question. And before we dive into that, I had to do a lot of learning on educating myself on a fund. I've networked with people that are doing it at an extremely high level that are currently raising on a $400 and $350 million funds right now.
Wow.
So I had to speed up that process and learn fast, but they didn't start where they are right now. They started with smaller funds, and they told me they gave me the blueprint to basically go ahead and basically create the fund and how to raise on the fund and all of that. So the first thing is, you can't raise a fund without experience, because your investors want to know what you've done, right? Doesn't go to show that, I mean, if you have a great pool of network, that's where some of your experience can come from. But growing up where I grew up, none of this information was accessible. I had to learn everything I've ever, I had to work hard for everything I got and really do a lot of education on that. So it's not accessible to where we are, but connecting with the right people helps you elevate that experience. So the fund model and the syndication model, the syndication is every time we get a deal, we go ahead and reach out to our investors and we say, hey, this is the deal. This is the raise. This is why we like it. Are you interested?
Yep.
We don't force anybody, and we always ask, and all of our deals that we put in front of our investors, they meet the criteria.
Yep.
Now that's a one-off deal, like you mentioned.
Right.
Now the fund, there's a lot of reasons why investors really like about the fund. One, if the fund is, let's just put a number out there, $5 million, and we're investing in 5 assets at a $1 million a piece.
Yep.
One fund allows you to diversify through 5 investments. Another thing that's interesting with the fund is if a firm is holding a fund, they're probably reviewing hundreds of deals a quarter, as opposed to you as a single investor that is going to look to invest 500,000.
Yeah.
You're going to do it 100,000 at a time.
Right.
But guess what? You have to look at 5 investments. Definitely 5 to make it happen.
Right.
You want to parse through, I would say, about 50 to 100.
Yeah.
To make sure you're investing in the right deal, making sure it's invested in the right criteria. So as a firm that has a fund, as long as an investor's criteria aligns with the firm's criteria, for instance, I'm a value add multifamily guy.
Yeah.
I like value add. I like cash flow. I like yield. I like wealth preservation. I like the hedging against inflation. My motto is beating inflation 1% at a time. Doesn't mean I jump in every deal. And it doesn't mean I do development.
Yeah.
I know where my criteria is, and I know the 5 ways real estate pays me. But if I buy it from cash flow standpoint, I'm already ahead of the game. So I don't want to do a development where I get no cash flow for a year and a half while it's being designed and built. And all of a sudden, now the capital comes and now there's a big exit. I get it.
Yeah.
It's a home run deal to me.
Right.
I like singles and doubles. So the fund allows me, with my investment criteria, my investors know these are the type of deals I've done in the past. These are the type of deals I'm using for the fund, and it allows me to have the capital ready to pounce on opportunities through a JV partnership. For instance, Will, if you had a fund and I had a deal, we can partner on a JV opportunity, and we both have the confidence to be able to go and take down a deal quicker than it normally would on a syndication, even though we are doing a thorough vetting process.
Yeah.
Right. The syndication process, what it is we're putting it on the contract, and now we're going to reach out and get the capital. The fund, we pitch the investors first and meet like up front. They know what they're investing in, and now we go and diversify on their behalf. Investors want to leverage a firm's ability to parse through and invest in opportunities that meet the criteria that they're looking into and that they're aligned with. Another thing investors like is 1K1 at the end of the year through the process of many investments. They know that maybe their $100,000 investment is now distributed equally, basically, in 5 different opportunities of a $5 million fund that I exampled earlier.
Right.
Just play that out and just being able to do that for investors, and also the communication and the returns on a quarterly basis on the fund. I mean, it just makes sense for investors to invest more in a fund than they would in a one-to-one syndication, because the fund investing in 5 opportunities doesn't mean they have to be all in the same market. They can be in Tennessee, Florida, Texas, and the Carolinas. Just imagine that through the investments of a fund. Now you're truly diversified.
Yeah. No, that's very good points, and it makes a lot of sense. That to have a fund set up. You did mention having experience. If you want to do a fund, so obviously anybody that's just getting started, it wouldn't make sense to them to jump right to a fund. But I guess one way around that would be partnering with someone that does have the experience. And, then when you're talking to investors, now it's not, Blow Joe trying to do his first deal, but hey, I got XYZ and he's done, 10,000 units or something like that. So it makes a lot more sense when you look at it that way. Now, as far as the fund goes, what are the requirements as far as sophisticated versus accredited investors?
That's a great question. It all depends on. It's similar to the syndication. because you are syndicating the fund. So you are offering a security.
Yeah.
So you can either go 506B, which is 35 non-accredited and the rest have to be accredited. And then you can go, but you cannot publicize it on a 506B. But on a 506C, you bring all accredited. You have to verify their accreditation. There's other sites like verifyinvestor.com that you can send your investors to get self-accredited, self-verified, and then they can return those documentations to you. Yeah. And that's the easiest, probably cleanest way to be able to do it. It's only a $60 fee, and any accredited investor is not going to gripe over a $60 fee to go and prove that they're accredited. And then also on top of that, the 506C, even though it's all accredited, it allows you to market and put it out there and talk about it with anybody. On the 506B, you can't really disclose it until it's completely drawn up and, you know, you have the deal under. Basically, if you have the fund, now you can start talking to your investors. You can't talk about the opportunity with new investors. You have to have a pre-existing relationship and go to the SEC to determine the website for the SEC to determine what the pre-existing relationship is. But also on a 506C, you don't have to have that, and you can take in as many accredited investors as it takes to fill the fund. So when you're doing a fund, when you I guess, you know, start the paperwork on, you have to set the number of what you're trying to raise on that, right? Yeah, absolutely. So if you're setting the paperwork to 5 million, and you set the baseline to about 2 million, as long as you reach the $2 million mark and you know you might not reach the $5 million, you can close the fund right there and you start working with that 2 million. There's different processes of doing it. It all depends on how you structure it. You can structure it with prefs. You can structure it with making it very investor friendly. The funds we do, we make very investor friendly. We also do capital call downs, which is another process of, well, if you invested 100,000 in the fund and we said, excuse me, once we close the fund, you wire 50% of it or 25% of it. And now we have 4 years of the investment period timeline. What does that mean? The investment period timeline means we have 4 years to go ahead and call down the rest of your capital through investments. Now, mind you, we're parsing through hundreds of opportunities and deals through our contacts. And that's just a quarter. And we're trying to take down 1 to 2 deals every quarter with the fund. With that said, every quarter can have a call down. And then there might be a quarter where we don't, because we don't find anything that meets our criteria. Criteria is very strict. It goes through some tough underwriting, even though if we don't find an opportunity and we're partnering with another group, we are underwriting that to our criteria to make sure it meets and matches our criteria as well. Because if they don't know our criteria, we're not partnering with them. But if they know our criteria, we will. And we build established relationships. It takes us about a year to partner with someone. Like any partnerships, it should take you a long time to get in business with someone. Just like you date a female or a man, you date them for a while before you committing to them long term. So that's what it looks like for us. We know that investors like that and they feel safe with us because of that model. And we don't just jump into opportunities because maybe it's someone of status or something like that. We want to know how they work and make sure it aligns with what we do.
So if you would, man, you know, what is the upkeep on doing a fund versus a syndication? Because it seems like if you do a syndication, you got your fees up front and then, you know, you're done. But, you know, as far as running a fund, you know, what do you typically run into with that kind of stuff?
So it's similar to the syndication. So you have the 2% asset management fee. So you have the 2 and 20 concept on a fund, and you have the 70-30 split, 80-20, wherever you set it up, plus the 2% asset management fee, 2% acquisition fee. And that's what it looks like on a syndication. On a fund, the 2 and 20, what does that mean? The 2 means asset management fee. The 20 is carried interest. So let's say that there's an 8% preferred return. Once the 8% preferred return is met, anything over that is now split 20% to the partnership, to the general partnership, and 80% goes to the limited partner. So let's say the 8% of a dollar, like the 8 cents of a dollar of, if there's $100, right?
Right.
The $80, I mean, the 8% of that is going to the partnership, the limited partners, 8%. Yep. And then anything over that, if the numbers make out, anything over that is split 20% to the partnership, the general partnership, and then 80% to the limited partnership.
Yeah.
And that's through the life of the fund. And also, there's no reinvestment period. That's such a great question on the fees. On the onboarding fee, there's a 2% onboarding fee similar to an acquisition fee. Sometimes it's 2%. I like to put it right in the middle of 2% because some groups will charge anywhere from 1% to 5%. That's kind of the range of anything in regards to asset management fee and a onboarding fee.
Now, let me pause you there for a second.
Fee. Go ahead.
Now, the onboarding fee, are you referring to when you take on a new asset, or is that when they send funds over? Is that when the 2% is charged?
Yeah. So here's what it looks like. It's when they commit to the fund, where they only pay that once we call it down.
Yeah. So
it doesn't get paid on capital we haven't called down. So for instance, like I said, if we told you to send 25% down, now that 2% is charged on that 25% down.
Gotcha.
Because if we called it all at once, we'd take it all up front.
Yeah.
We don't do that. We want to be in alignment with the investor. So the onboarding fee is only on capital that has been called down. So 25, as we start calling down through the investment period, it'll be used on that. So everything will be prorated to what your investment is within the fund.
Yeah. Yeah.
That's another great question.
No, that's, I didn't know that, man. So I'm glad you shared that.
No, there's other models where groups with funds, they call it all down on day one, and then they go ahead and they start working with it, and they don't have to call it down ever again because they have all the capital up front. Now they're just generating the returns off the pref that they're using. So the reason why we don't do that is if we don't have an investment, like I said, it takes us we're looking for 1 to 2 deals every quarter. Yeah. And if we're not investing all of the capital, we don't want to pay a pref on a capital that's not used. So we say, hey, hold it until we find opportunity and we'll call it down. You're already committed to the fund, which means you're already in the deals when we find them. Right.
Now, what happens if you're doing this call down strategy and, I guess whatever the investor is, they spent the money, the money they had set aside, they spend it. So do they lose their stake in the fund, or what happens at that point?
They don't lose their stake completely. That's a great question. Their prorated shares are now distributed amongst everybody else. So their shares are a little bit diluted, and the capital that they have in is what they remain in the deal as.
Yeah.
You can structure it so they lose everything, but that's not investor friendly.
Right.
It's actually, we like to do everything on an investor friendly ideal, and our partnerships with any investor, if you commit, we're issuing a promise on the investments that we're bringing to the table, and you're issuing a promise on the capital that you committed to the deal. Yeah. So after the 4-year investment period, if we haven't exhausted all the capital, then we release a memo saying, hey, we only invested 75% of everything. Now the 25 remaining, you're free to do whatever. We release that hold on that capital per se.
Gotcha. No, that's good to know. All right, man. So let's put on the operator's hat as far as, the guy that's out here trying to put deals together, and, obviously you need capital to play in this multifamily game. What are some tips or strategies that you can give someone listening right now on how to go out and attract, accredited or sophisticated investors to partner with them on deals?
Well, you got to just kind of use your network and leverage from there, and then go ahead and start finding opportunities that meet with that criteria of what you have an interest of investors with right now. And if you don't have friends and family, start talking to people that go on a conference and talking to people with like-minded mentality. Join meetups, join those type of groups. There's capital out there. It's out there everywhere. You just got to go ahead and put yourself in a position. If you're like me, you weren't around it growing up. So you had to go ahead and find out I don't golf. I want to learn how to golf, but I would love to be on the golf course. I just
Me and
don't
you
know how to
both.
golf, right? It's one of my things that I want to do. I want to travel as much as possible. Another thing, find face-to-face time with investors. That helps.
Yeah.
Because if you can put down a criteria list of what you're looking for or what an investment typically looks like. I like to put down my last investments on a piece of paper and say, this is what we've done in the past and this is what it looks like. And, if, start answering the questions from there because you know all the answers.
Right.
You just need to have the confidence to go ahead and put yourself in those positions. And then reaching out to people, you're gonna have a lot of conversations.
Yeah.
If you're raising on anything, whether it's 500,000 to 10 million to 400 million, you're having a lot of conversations and you're on the investor's time. Yeah. So if you're on the investor's time and they say they can only talk at 8:00 at night, you're talking at 8:00 at night because you're on their time. You want to make sure you answer their questions so that they're comfortable. Yeah. It's alternative investments for a reason. Right. Investors either know about it and know about the process, or they need to be handheld and walk through it. Right. So hand-holding investors and walking through it should be something you practice daily. Yeah.
Yeah. No, that's all great tips, man. And I know if people are not using LinkedIn, man, I've been making some great connections on LinkedIn, and I met you on LinkedIn, so
Absolutely. I mean, LinkedIn's awesome. Yeah. It only gets you so far. Sometimes you just need to, obviously people are trying to have conversations and book meetings with you on their agenda as well, because they might have a product that they're looking to, sell. It's a very professional atmosphere. Nothing wrong with it. Yeah. But you can find some investors out there. And my goal is, at the end of the day, I don't want to come off as the salesman. I want to come off as a solution. I'm trying to be a part of your financial team. I'm not trying to replace anybody on your team. I'm not an accountant. I don't do taxes. I'm not a CPA. I'm not a financial advisor. Right. I'm just trying to provide a solution as an alternative investment that your team can parse through, and we work hand in hand with those type of individuals and professionals to get them the necessary documents and to collect the necessary documents that we need.
Yeah. Yeah. No, that's a great point. Great point. Now, we also was talking about some deals that you decided not to do here recently, man. Let's talk about some of those, or one of those deals. What didn't you like about it?
Absolutely. So, for instance, we talked about something earlier before we started recording, and you mentioned something where you didn't want to jump in a deal because you felt like numbers are stretched. I didn't jump in a deal because the GP partnerships was 85-15, and the 85 going to the LPs, and it wasn't the group's first deal or something like that. Usually, you see a partnership like that on opportunities of first deals. Yeah. And for me to look at that and then start looking at the underwriting and really see that they were squeezing the numbers, even though the opportunity itself was in a really well-respected area. Yeah. I know the other opportunities in the area. It just didn't feel comfortable for me to put in front of my investors. Yeah. It didn't feel right. It didn't have that flow. It was a value add. I like that about it. But there was a lot that I didn't like. So if I have 10 points of criteria, 6 of them have to be met at least for me to start considering and diving in deeper. Yeah. And I wasn't comfortable. It was probably like 4 that was met, and I wasn't comfortable. So anything below that 6, I'm not trying to get involved. So that was a deal, and it was in Texas, one of my favorite markets. At the end of the day, passed on it. And I guess it's doing fine. I'm not sure. I never follow up on opportunities because once I let it go, I'm focused on the next and focusing on our own. So I don't want to go back and say, oh, I should have. I don't live that way in general. And at the end of the day, I don't do that with my investments. I pass when I pass, and I move forward when I move forward. Yeah. Yeah. No, that's a great practice to have. Now, you did mention underwriting, so let's just talk about that for a moment, man. When you're underwriting deals, just some helpful tips that you can give the listeners. Yeah. So right now, especially with COVID right now, we're underwriting with no rent increases for first 2 years.
Yeah.
And just to be safe, and we want to be safe because
Yeah.
we're conservative from the beginning. At the end of the day, we're a small boutique firm.
Yeah.
And small boutique firms are trying to find the right investments for their investors, because their investors, we're trying to over exceed. We're, you know, under promise, over deliver, right?
Right.
Right. So at the end of the day, we're looking for not home runs, singles and doubles where the cash flow's there, boom, 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 boom.
Yeah.
And I'm not literally trying to hit a home run. I'm looking for something that meets the criteria. And then that's part of that is the underwriting. One of the things that a lot of investors don't do is they don't stress test the deal, but also they don't confirm the assumptions. They want to go by rules of thumbs, and I hate rules of thumbs. Rules of thumbs are placeholders.
Yeah.
Every market is different. Texas, you can do a certain amount for renovations. In Tennessee, a certain amount for renovations. Don't use a 4,000. I'm just going to put 4,000 per unit. No, it doesn't work that way.
Yeah.
Especially not California, Florida, especially with the cost of construction going up right now. You got to be fine-tuned and aligned with that. And how to do that is working with your PM and confirming those, because if you give your PM a business plan where, let's just say you said 4,000 per unit for renovations. Okay. You give it to your PM and your PM is like, hey, Will, it's 5,500 per unit for unit turns. You're already put in a bad spot because you only raised on that $4,000. So now some units probably ain't getting renovated that you already projected, and that eats into your returns. And being conservative, where usually people were putting anywhere from 2 to 3%, maybe even 1% on rent increases per year. Right now we're being so conservative that we're putting it at 0. We're saying that we're going to keep the rents as is for 2 years. And, maybe if the asset's big enough and you increase the rent by $1, that's still an increase on the NOI. But we're not even thinking that way. But we're just trying to be more efficient and trying to run and operate the asset better than the last previous owners.
No, that's and that's a good point there. And as far as your underwriting go, you're not putting anything in there for rent increases. Are you guys putting any projections for bad debt increasing because of COVID and people losing jobs?
Well, that's the thing right now, where you got to underwrite for 18 months. We had a deal on the table where we underwrote for 9 months, and it worked at 12 months of reserves being held from the lender, for the lender. And that was a lender requirement. They came back, and we had the deal already in contract. They came back, and we were reaching out to our source again. And it's a fluid transition. You got to have everything in line. So we reached back out and said, hey, we're looking at this debt when we took it under. And they said, yeah. It's funny how a week later, during COVID, it went from 12 months to 18. 18 kills our projections, kills our returns. And literally a deal we had in contract, we had to walk away from. So that's a great question. You got to be in fluid, and things change on you. So you got to walk away from deals that a week earlier you had in contract and it was looking really promising. So that's what the tides do these days. And, I love that you asked that.
No, I mean, people need to know, it ain't all sunshines and rainbows, right?
Yeah, man, because here's the thing. The lender's your biggest partner. The lender's your biggest passive investor. They're bringing so much capital to the deal, and you're bringing another amount of capital. But sometimes the lender is bringing some repair capital to the deal too. That's how much they believe in the deal. So that's one of my criteria is how strong is the lender lending on this opportunity. And if it's strong, that's one of my criteria is because of the fact that they are your biggest partner. They
Right.
love the project. So that's what it tells me.
That's a great tip there, man. If the lender believes in it, then that's enough to get you at least looking at this thing seriously at that point.
Yeah, that's one of my questions I ask. I say, when I'm looking at a deal, I want to see what you're quoted and how much they're lending on the opportunity.
Yeah. Got you. All right, man. Let's go ahead and segue to the last segment of the show. It's a lightning round. A couple questions for you.
Let's do it.
All right. What's the best advice you ever been given?
Just do it. Because if 5 years of analysis by paralysis got me nowhere, the last 2 years of just doing has got me where I am today. And I'm not saying I'm at the top or whatever, but it's moved the needle for me. So
yeah, man, I'm about to say Nike better put you on a
it's ironic that I'm wearing this, but I'm wearing a Nike shirt for those listening.
Yeah.
Just do it.
Yeah, absolutely. I love it. Best book you've read this year?
This year, I just finished Ninja Selling, and that was phenomenal. And I'm starting to listen to So Good They Can't Ignore You.
I'm gonna have to check that one out. That sounds like a good book.
Yeah, I'm a couple hours into it, and I love it, and I use it during my runs.
Yeah. Gotcha. What are some rituals that you've created that's making you a better investor or person in general?
Man, I meditate every morning and I journal every morning. And I meditated every morning for a long time. And I was partially journaling in the mornings and it wasn't consistent. But during COVID, I was part of a 21-day Deepak Chopra challenge with some investor friends of mine. And it really helped me start honing in on my meditation and journaling. So now I journal every morning. And sometimes it's about the previous day's activities and how blessed and fortunate I am to experience them.
Yeah. And
then sometimes it's just about the struggles that are limiting me. So when I uncover that through meditation, I write about it. So it's pretty phenomenal what you discover about yourself. And the 21-day meditation really, I guess it ingrained it in me. And I've been fortunate to be a part of that group.
Awesome.
Great question.
Awesome. Yeah, for sure. What is one thing?
And I work out, but I listen to my body when I'm working out. So if I don't feel like my legs are tight, I'll just do stretching that day or something like that. But I work out because I got to stay in shape because I'm a basketball referee.
Yeah, that's cool. That's cool, man. Yeah, you run up and down that court, you definitely got to be in shape.
I love it, man. I love it.
Yeah, for sure, man. What is one thing you're doing right now to help you improve your business?
Man, that's such a great question. I'm talking to people that are doing things higher level than I am.
Yeah.
And I'm seeing what they're doing that I haven't implemented. Since I've been practicing that, I've implemented a better CRM system, a better investor portal. I didn't have one. I was keeping everything. I've created calculators for passive investors to compare opportunities and not only compare them from sponsor to sponsor, but the calculators, but it compares that. I switched to prepare. That's why it confused me.
Yeah.
It compares the investment from the projections to what its actual performance. So as you get in your returns in real time, you get to go ahead and list that every quarter on the calculator and say, okay, it's on par or it's not. So you get to know what opportunities and what market you're investing in. And it really helps you confirm whether the investment was the right investment for you or if it wasn't, or if the market's the right one for you. So it confirms if you really like that market.
Yeah. No, that's a great tool to have. Now, if you can give your younger self one tip in regards to investing, what would that be?
Man, find out someone that's investing and go and pick their brain, because growing up where I grew up, no one I knew was investing. I bet you my parents did. So I wish I asked my parents, hey, who do you know is doing this? And I wish I would have had those conversations. I wish I would have asked more questions when I was younger. So I guess I would tell them, find out who's doing it where, when, how,
Yeah.
and go and talk to them or even work for them.
Yeah. Great advice. What's the worst job you ever had?
Man, the worst job I ever had was when I was working for this company. It
Yeah.
was an air conditioning company. We were going in and installing the ductwork and the machines and basically buildings that were being made. And sometimes we were going to replace in existing buildings, and I absolutely hated it. It was just something that I knew that I wasn't going to do in my life. And I just hated it at the time. I never been asked that.
That's a hard work, right?
Well, it wasn't because it was not because of the work, because I do projects around the house. It's not because of the work. It's just that I knew I didn't want to do that for a living.
I got you.
I'm grateful for the people that do it, though. I have a buddy that does it, and he's really good at it, and he loves it.
Yeah.
I never fell in love with it like that.
Gotcha. All right. Last question for you. Your rich uncle just left you $1 million. It's tax-free. What are you doing with it?
I'm probably going to KP a sponsor on deals. That's
Nice.
a quick answer.
Yeah.
But if I'm KPing a sponsor, I get X amount.
Yeah.
For just signing off on the loan.
Right.
And that capital, as I guess it's contradicting as it's going to sound, that capital is actually working to my benefit as I'm KPing. But if I don't have access to deals, let's ask that question.
Yeah.
If I didn't have access to deals, I'm investing in multifamily. I'm probably going to buy the biggest asset I can. All right. I'm going to diversify into multifamily because that's what I know. But I'm trying not to think as where I am right now, because I'm where I am right now by the biggest asset I can and control and operate it efficiently. Right. So, but end of the day, I'll probably split up into two biggest assets, 500,000 a piece. And go about it that way. But if I'm not thinking about it that way, I'm going to invest it in 100,000 chunks, 250,000 chunks into operations that I feel with firms. So let them go do what they're doing. Right.
Great answer, man. Well, hey, man, that's the end of the show. John, I appreciate you coming on, sharing all the knowledge, wisdom. You dropped a lot of gold nuggets today, man. And I'm sure I probably got some listeners that want to connect with you. What's the best way for them to reach out to you?
First of all, thank you for having me on the show. I'm very grateful to be here, and thank you. The best way to connect with me is johnfortes.com, Fortes. You can listen to the podcast at passiveinvestorshow.com. And, please leave Will a written review because it means the world to us as podcasters.
Appreciate that, man. Appreciate it.
Thank you for listening to the Generational Wealth Through Commercial Real Estate podcast, brought to you by Onyx Capital Investments. Onyx Capital Investments works with investors nationwide to invest in income-producing real estate in emerging markets. Connect online at www.onyxcapitalinvestments.com to learn more about what we're doing. If we have added value to your life, please leave us a review.